Today we're breaking down the October 29th Fed rate cut and what to expect for mortgage interest rates moving forward. Yes, the Fed announced another rate cut, but it's not quite the green light for mortgage rates that you might be thinking. Today we'll talk about why mortgage interest rates didn't really move, what Jerome Powell said exactly about the economy and inflation, and what we can expect for mortgages heading into 2026 and beyond. And before we dive into it, if I haven't met you yet, my name is Connor Webb. I'm a mortgage loan originator licensed in Washington, Oregon, California, Idaho, and Arizona. If you have any questions or if you're thinking about buying, selling, or refinancing in the next year, reach out. I'll have a link in the description of this video to reach out and connect. So starting off, what exactly did the Fed do this week? Well, to start off, the Federal Open Market Committee voted to lower the federal funds rate by 0.25% or 25 basis points, setting a new target range of 3.75 to 4%. This came as data showed that the US economy is still growing moderately, but job growth has slowed and unemployment has ticked slightly higher, signaling a softening labor market. Powell summed it up by stating that the Fed is driving in the fog, that there's relative uncertainty with where things are heading. They're moving carefully, collecting every scrape of data before deciding what's next. The Fed is easing slightly to support the economy, but not declaring a full-blown victory over inflation, as they're still working to get that number down to 2% on an annual basis. They're acknowledging progress without a full-blown slowdown. So why do mortgage rates not drop immediately following a Fed rate cut? Well, here is where most people get tripped up. The federal funds rate and mortgage rates are not the same thing. The Fed controls short-term rates, things like credit cards, car loans, and home equity lines of credit, whereas mortgage rates, on the other hand, are determined by the bond market, specifically the yield on the 10-year Treasury note, which reflects long-term inflation expectations of the economy moving forward, and overall investor sentiment. So even though the Fed cut by a quarter point, mortgage interest rates didn't really see an effect as the bond market had already priced this in. In fact, right after the announcement, mortgage rates stayed relatively flat, hovering in the low to mid sixes in most cases for a primary residence, of course, differing depending on the loan type and the property type. Think of it this way, the Fed sets the tone, but the market decides the melody. Now, while investors are currently anticipating another rate cut coming in December, Jerome Powell's comments at this meeting were essentially to pump the brakes a bit. He stated a further reduction in the policy rate at the December meeting is not a foregone conclusion, in fact, far from it. That tells us that the Fed is staying flexible. They want to see more evidence that inflation is moving sustainably lower before they commit to a series of cuts. He also said, "We think policy is still modestly restrictive. That's one of the reasons you see a gradually cooling labor market, so that should help get inflation down." So what this means is that even after the cut, borrowing conditions are still tight enough to slow the economy and reduce price pressures. And Powell reinforced their main priority. We are absolutely committed to returning inflation to 2%. You'll see that's where we're going. So while some people think this is the start of a big pivot, Powell's message is not yet. They're trying to balance patience with progress. So let's talk about the backdrop that the Fed is trying to navigate. Unemployment is still historically low in the mid 4% range, but it's up from earlier this year, signaling fewer job openings and slower hiring. Inflation, meanwhile, has crept back up a bit, sitting somewhere between 3 and 3.5% depending on the measure. That's well above the Fed's 2% goal. This is the classic tug-of-war moment. Inflation's not defeated, but growth is clearly cooling. Powell even said there were strongly different views among Fed members, some wanting a bigger cut, some wanting no cut at all. That division shows how uncertain things are right now. The Fed doesn't want to choke the economy, but they also don't want to declare victory when prices are still rising faster than they'd like. So why are mortgage rates still stubbornly high for homeowners and buyers? This all translates to one word: patience. Mortgage rates are still influenced heavily by investor confidence. If investors think inflation will stay higher for longer, then they'll demand higher yields on bonds, which means higher mortgage rates. Even though the Fed's rate cut should make borrowing money cheaper, the mortgage market looks further ahead. It's saying we want proof that inflation is under control and that the Fed won't have to reverse course. That's why you didn't see a big dip in 30-year fixed mortgages. Lenders and investors are still cautious about long-term price stability. So looking ahead to 2026, what exactly is coming next? If the data shows inflation continues to cool and unemployment continuing to rise, then we should see a few rate cuts in 2026. Each one would slowly ease the pressure on long-term bond yields, which means that we could see mortgage rates dip below 6 and into the mid-5s by the end of 2026. But this is the key. If inflation stalls or if we see the economy pick back up, that means that mortgage rates could stay higher for longer. As Powell said, we're going to collect every scrap of data we can find, evaluate it, and think carefully about it. That's Fed speak for we're flying cautiously. So bottom line, don't chase headlines. Focus on your own timing and strategy. Mortgage rates don't live and die based off of the Fed's move. They're more of a reflection of the overall economy. If you're buying or refinancing, focus on what you can control, building your credit, paying off debt, and your readiness to act when the opportunity comes. I'll keep you updated as we see more changes moving forward. And if you have any questions, reach out. Again, I'll have a link in the description. And for more content like this, make sure to like and subscribe, and we'll see you in the next one.